Hi, everyone. Thanks so much for checking out my show, Coin Stories, where I get to hear from the leading voices in Bitcoin, financial markets and investing, political structures, philosophy, and more. Please make sure you're subscribed to the show. And if you're watching this on YouTube, like the video so more people see it, and hit that notifications button so you don't miss out on any new content. This podcast does not provide financial advice. It is for educational and entertainment purposes only. So make sure to do your own research before making any investment decision and be aware of your risk tolerance. I'm able to produce this show thanks to my sponsors, and I'm very picky about who I choose to partner with. So I hope you take the time to listen to the ad reads throughout the show. All right, now to my first partner, where I buy my Bitcoin, Swan. I'm proud to partner with Swan because it is a Bitcoin-only company focused on helping people save for their future and self-custody their Bitcoin, not trade it. Swan offers a private client service, retirement planning, tax loss harvesting, and even home equity conversion. Swan is also committed to educating millions of future Bitcoiners through free educational resources and media projects. I actually use Swan to dollar cost average every day. I deposit a little bit every day that's equivalent to what I might spend on a meal because I actually read that dollar cost averaging daily ends up with a lower cost basis than weekly or bi-monthly at the end of a given year. Swan also produces my show, Hard Money, which reports on Bitcoin adoption and macro trends around the world. So make sure to subscribe to that as well. And to learn more and get $10 in free Bitcoin when you sign up, head to swanbitcoin.com/Natalie Brunell. All right, next up, Bitcoin Conference 2023. This is the ultimate Bitcoin event every year, and it's going to be held once again in Miami Beach, May 18th through the 20th. Last year, there were about 30,000 attendees, and it's hard to believe the scale until you see it in person. There are incredible speaking sessions featuring the world's biggest Bitcoin voices, networking events, games, parties, and of course, Soundfest. I actually credit my career transition to the Bitcoin conference because I went for the first time in 2021, and that's where I dropped my first episodes of Coin Stories, not expecting this to become my full-time job at all, but just hoping to meet Bitcoiners and find more guests for the show. I actually went up to people like Michael Saylor backstage with a business card, and that's how I got him to come on the show. So anything can happen there, especially if you dream of working in the industry. Ticket prices go up every month until May, so don't miss out. And for 10% off, use the code HODL at b.tc/conference. I'll see you there. Well, Lyn, what a week. The first question, I would just love for you to sum up, if you can, maybe in a sentence or two, what is your reaction to what's happened this week?
Combination of Fed policy error and individual bank risk management failures. So I see a lot of people blaming, either the banks or blaming the Fed exclusively, whereas like most things, it's a mix. And so basically, it's kind of a toxic policy combination and just individual bank mismanagement.
Are we at the beginning of another real financial crisis?
I don't think not in the same way in 2008. In some ways, it has parallels to the 2019 repo rate spike, which not everybody's familiar with. But it's more severe than that, but not as severe as 2008, at least in the United States. And the reason I would describe it like that is 2008 was really a credit problem, which means that banks made very aggressive and ultimately bad bets. They lent money to entities that defaulted. Whereas here, we're not really seeing that. It's not like they got overly aggressive and made bad loans that are defaulting. Instead, what they did was they ironically bought very, very safe assets, but they bought them at high prices, meaning low yields. And as yields have gone up at like a multi-decade high rate, a year-over-year rate, a lot of those securities are now underwater in price. And it's actually fine if they're able to hold on long enough because those securities will pay back all their money, or at least, the vast majority of them. The problem is that if they can't hold on long enough, if their deposits get pulled out and they have to sell their assets for a loss, that's when they basically make those losses real. Kind of a secondary and longer term problem is that if deposits flow out of smaller banks and towards the larger banks or the money market funds, then those smaller banks have to raise deposit rates in order to entice capital to stay there. And then the risk there is that they hurt their profitability because they're holding these low yielding assets, probably till maturity, at the same time as they're paying out higher deposit rates. So I would say this is essentially a shock to the system when you raise rates this rapidly and then it kind of finds out which banks manage that exposure better than others.
Well, let's dig in a little bit with Silicon Valley Bank, because that was sort of the first domino, and exactly what you just mentioned happened. They essentially bought these long duration bonds because they were chasing yield in a zero interest rate policy environment, and then they had to go sell them when depositors came and wanted to get their money out. Can you paint the picture of, pandemic started, fiscal stimulus goes into motion, and all of a sudden you have PPP loans and stimulus checks, and those are all going to these banks, right? So that's where all of a sudden they were flush with cash. They were buying up these Treasury securities. And then when did the problem sort of surface as the interest rate hikes started?
Sure. Yeah. Basically, to zoom out, there was like that 40% increase in the broad money supply in a very short period of time, and most of that broad money supply is bank deposits. So banks, even though those are customer funds, those are liabilities for the bank, and they're holding them for the customer. So they basically had an influx of deposits, and they had to invest them in something. And a lot of them put them into relatively safe securities, things like treasuries or mortgage-backed securities, which are among the safest assets that a bank can hold. The problem is that those have duration, right? So they might be like 5-year, 10-year, or longer duration assets. And you had this record increase in the broad money supply, super low rates, and then it led to inflation, among other factors. And so the Federal Reserve freaked out and completely, 180-degree reversed their monetary policy. So they started sucking money out of the system, and they started hiking rates at the fastest rate since the 1970s. And so all these banks that bought these longer duration safe assets suddenly found their positions underwater. Now, there's two big risk factors that go into why this particular bank had such a big problem. One was that their deposits were not very high quality because they were concentrated in one industry, tech startups. And because they're mostly business bank accounts, most of them were well above the FDIC limit. And so they had, they're at risk of loss if there should be a bank failure. And so they're basically deposits that are very, very quick to want to move at any sign of a problem, which is not the case when you have a very diversified and smaller, kind of a large number of small accounts. So one is their deposit base was at risk, and the number two is they did not manage their duration well. A bank like JP Morgan, for example, got more into shorter duration types of assets, so they had less losses when interest rates increased so much. Whereas this particular bank, basically made a pretty big bet on long duration assets, which is not like the riskiest thing you could have done, but it is risky because those are relatively safe assets, but they have pricing risk. And so that bank had a particularly large amount of losses relative to its capital, and had a very flighty deposit base. And a number of other banks that either were taken down or were kind of on the verge of going down had somewhat similar risk profiles, both in terms of the deposit side and the unrealized losses side. Whereas banks that have held up better are ones with either a more diverse and larger deposit base, and that have less losses because they in general because they bought shorter duration securities, or a lot of their assets are their own loans on their book and therefore aren't really marked to market in the same way.
Well, and when SVB had to go sell those long duration bonds, they had to mark to market. So they were at a loss. They tried to raise equity and they couldn't. So is that essentially how they collapsed that weekend? And then the government stepped in?
Yeah, that's basically what happened. And then there was a big decision of whether or not they want to back up all depositors, because most of them were uninsured. But at the same time, the policymakers want to restore confidence in the rest of the banking system. One of the big challenges is that, of like the 17 trillion plus deposits that are out there, the FDIC only has, less than 1% of those deposits backed up by insurance. Even the ratio that is fully covered by insurance, they only have something like 1.3% covered. Now, to their credit, I mean, since 1933, they've never not paid on a insured deposit before. But basically, it's one of those things they don't want huge, vast bank runs happening. And a lot of this is a confidence game. That's kind of the whole game of fractional reserve banking, is that these institutions are inherently unstable. I've described it as basically like we're all just casually storing our money in leveraged bond funds. And so obviously that's, if you phrase it like that, would you say, is that a low risk investment? People would say, no, of course not. But that's what we all just casually use for our, savings. You would just put grandma in a highly leveraged bond fund, and that's where she holds her money. We kind of normalize that. And so they wanted to backstop confidence in the system. And they've also added this liquidity facility. It ironically generally benefits the larger banks because you can only use that facility if you have a lot of high quality liquid assets. And whereas if you look at the long tail of smaller banks, they're generally more loan driven. They hold illiquid loans that they made and that they're not really easily resellable. And so they can't use that particular facility. And so I think we're in an environment where the large banks are pretty well protected, whereas small banks probably still face ongoing challenges.
Is the government's intervention in this case a bailout?
Partially, yes. I mean, basically, the non-insured depositors, they would have gotten most of their money back, but based on the losses that the bank had, they would not have likely gotten 100% of their money back. So that was that's basically socializing losses. Basically, other banks are going to absorb that cost over a wider base to get those uninsured depositors whole. So that's number one. And then two, this facility that the Fed and the Treasury put in place.
The
You know, it,
BTFP?
exactly, yes, that facility. That is sort of a bailout in the sense that it's not free money, but it is selective access to below market credit at above average terms. So basically, it's easier credit than they otherwise would get on a open market basis. Now, if you zoom out, I mean, the whole system is kind of artificial, right? I mean, when all these banks are building their system on top of the Fed, and the Fed is actively managed by a central entity, it's like both sides are bailout. The whole system is kind of one
Mhm.
giant ongoing bailout. But yes, this particular action did have characteristics that were at least partially a bailout.
And when the president went on camera and said that taxpayers will not be paying for this, is that disingenuous?
It's one of those things around the margins. It's different than if they just outright gave the money. I would say that people are going to pay for it, not necessarily through the government budget. They're going to pay through it by their overall cost effectiveness when using banks in general. The Federal Reserve's liquidity facility is backed up by 25 billion in Treasury capital to absorb any losses that they might incur, which seem somewhat unlikely. And so overall, taxpayers are not really sort of taking a direct hit from this, but it is a spread out cost among all market participants.
So going back to the BTFP, why are foreign banks eligible? And maybe let's touch on what's happening with Credit Suisse because it seems like the European banks now are imploding.
So foreign banks, some of them have branches in the United States, and they tie into the dollar-based system, and so they're able to use that facility similar to how domestic banks can for similar purposes, because otherwise you have the long chain of offshore dollars kind of coming back and causing problems in the domestic banking system. As far as Europe is concerned, that's more of a developing story because that's really happening today. But it's kind of bringing up old wounds. I mean, Credit Suisse, for example, has just been this ongoing slow motion train wreck of losing deposits and, basically it's becoming riskier and riskier, losing its major investors. And so that's been kind of an ongoing, everyone kind of assumes that's eventually going to fail, even though it's a systemically important bank. The question is what does eventually bring it down, or will it be kind of kind of gradually broken up and somehow just absorbed into other banks? Like how's that going to be handled precisely? But basically, the problem is that if you're a European investor, it's actually harder to get a bailout in general because there's not one country with the government and the central bank on the same page. Instead, they have a bunch of different governments, and then at least for most of those countries, not Switzerland, but most of the countries, they have one central bank, and so their banks are actually more at risk of basically a failure, more risk of having a bail in rather than a bailout, which is basically where the depositors bail out the bank. And so the challenge there is that suddenly kind of overnight, everybody has to be a bank expert and has to look at their banks, their financial filings and determine whether or not they feel safe holding them. Basically, if someone invests in a leveraged bond fund, you'd expect them to do a lot of due diligence on the risk of that asset. Whereas that's not, of course, how most people treat banks, because they partially because they're insured, but also partially because they're just supposed to do the services we expect, even though it's actually, when you look under the surface, it's actually a pretty, weak foundation.
Well, my understanding is there are many more banks that have these unrealized losses on their balance sheets. Many of them took the same risks with those long duration bonds that SVB did. So, what are you watching for next? And could this become very systemic?
So, I would hesitate to compare it to 2008 in most ways, or compare it to a similar magnitude, because it's more of a liquidity problem than a solvency problem. I would say one of the big systemic things to watch is how the Federal Reserve is going to respond to this. Because, back in 2008, that was a very hard problem to solve. The Fed can solve this practically overnight if they want to cut rates and put liquidity back into the system. But of course, with inflation at 6%, that's not something they want to do, right? So it's really that combination. And this is a theme I've been talking about for a while, which is that the Federal Reserve is kind of fighting 1940 style fiscal driven inflation with 1970 style monetary policy that is mainly meant to curb bank lending, even though bank lending is not the major cause of inflation here in the 2020s. And so I think ultimately the Fed's going to face a choice, which is either let inflation run away, or try to backstop the banking system. And it's one of those things where, I mean, it's very easy for them to save the banking system if that's what they decide to do, and prevent, a lot of deposits just flowing into the big banks and flowing into money markets. But that comes with a big cost. And it's just one of the challenges of having an actively managed financial system and their ongoing cycle of putting out fires that they themselves caused. I mean, for example, after the dot-com bubble, that was a mild recession by most accounts. Unemployment rate and GDP contraction were pretty mild, and yet the Federal Reserve cut interest to 1%, which encouraged a lot of real estate leverage, and then they rapidly hiked interest rates. And that wasn't the only factor, but that was a contributing factor to the 2008 financial crisis. And we kind of saw a similar, but somewhat less severe dynamic this time, which is you do record stimulus, both the fiscal authority and the Fed, flood everybody with deposits at zero rates. They buy assets, and they said they did not see inflation. They did not expect inflation to come. They said they weren't even thinking about raising rates. Then of course inflation does come, and they raise rates by the quickest pace since the 1970s, and they rapidly try to pull out that liquidity from the system, and then it starts breaking the small and medium-sized banks. And so this fire was partially caused by they're putting out a fire that they lit a couple years ago. And so now the question is, are they going to light another fire and then put that out again, or how are they going to deal with this?
Right. It seems like a combination. The Federal Reserve certainly created this environment, but then also banks have to be responsible for their risk management as well. If you were in charge, Lyn, at this point, with what you have in front of you, what would you do if you were Fed chair?
I'd probably resign and ask Caitlin Long to take it over. Um, I think another test is, Powell had an exit. I mean, he could have left before, and he wanted to be, basically re-put into that position. I think basically anyone who runs a central bank or knows how to run it wouldn't want the job, because in Powell's defense, there's really no good answers here. The system's not designed at this point to handle rate. Just, people often say that if he just has like the guts to be like Volcker, he can fix this. Whereas not really, because it's not a 1970 style problem. It's a 1940 style problem. And, when you have massive fiscal deficits that are causing the underlying inflation combined with supply side problems in energy and labor and things like that, there's kind of rolling problems there. Monetary policy tools are not really the right tools to address that. Basically it's more of a fiscal type of challenge. And so I think the concerning thing is, by even wanting that job, it makes me question whether or not he understands the nature of the problem, which is funny because, he, it's easy to play like central bank, like everything what they could have done, should have done. And that's where I'm hesitant to blame him, other than pointing out that there's really no good solutions here. And it's really the underlying structure of the system that's the problem.
Well, and honestly, it does feel a little bit like wash, rinse, repeat. You blow up one bubble, pop it, and then you have to taper it over and hit the money printer again, lower interest rates. We already went to zero. I mean, where does it go from here? How many more times can they pivot again and lower interest rates before at some point we lose all credibility?
That's mostly that's predicting that is basically predicting human behavior, which is challenging. If you look at inflation break-evens right now, the market is expecting low long-term inflation, right? So if someone thinks that's correct, then the Fed's fine. They can hold interest rates, here, they can lower them a little bit, and things will be fine. On the other hand, if they view that that's mispriced and inflation is going to be a recurring problem this decade, then I do think you're going to get recurring losses of confidence in the overall banking system. And some are more vulnerable than others. I mean, I think Europe's very vulnerable. United States a little bit less so, but we can still shoot ourselves in the foot and cause these types of problems. And so I think it's been an ongoing problem. It's not something that happens overnight in developed markets, but it's something that year after year after year, more and more people begin, kind of questioning that whole thing.
Well, I know you've tweeted about bank consolidations, and it's a trend that's been ongoing. We're seeing fewer and fewer banks, more branches of those, fewer brands of banks. But is it accelerating now? And can you touch on that?
We're seeing early signs of acceleration. I mean, obviously, public companies usually update detailed things every quarter, but from early signs of reporting and things like that, and just talking to companies that I'm familiar with, there is a flight from smaller banks towards larger banks. Um, and that's obviously not super healthy because having a large number of banks kind of decentralizes lending decisions, whereas having a smaller number of banks centralizes lending decisions and access to money in general. But it's kind of a structural trend with how they've designed the system. It naturally favors larger and larger entities with lower and lower cost of capital all the way up to the source. And so I think as long as the system's in place, that's kind of the incentive structure that's designed to happen. But the Federal Reserve, of course, can exacerbate that. So, when they did quantitative tightening in 2018 and 2019, that came out of small banks and big banks pretty evenly. And if anything, it came out of large banks a little bit faster. Whereas this time around, they put so much liquidity in the system and then sucked it back out. But the problem was that it came disproportionately out of small banks. So the question is, whose fault was that? I mean, that's partially the Federal Reserve's fault, but it's also just the underlying nature of the system to consolidate over time, the way it's designed at least.
Well, I know so many people have just been waiting for that pivot, waiting for something to quote unquote break. Obviously, they have broken things as they work to tighten and fight inflation. So, what can people expect next, and what are you watching very closely right now?
Right now, I'm looking at the 2-year Treasury yield, the 52-week Treasury yield, market expectations of forward Fed policy, because we just saw one of the biggest repricings of short-term Treasury yields on record. We have to go back to the 1980s to see a similar rapid move. And historically, when you see the 2-year plunge below the federal funds rate with that speed and at that magnitude, that's kind of a signal that the Fed funds rate is probably done. Now, this cycle has somewhat unprecedented elements to it, so we can see how much Powell wants to kind of push things. But overall, I think the market is basically saying the Fed's done. We're at kind of a pause or a mild cut phase of the cycle. Lending decisions are going to be tighter now, which can increase the odds of a recession. And so we'll see what happens. We're already seeing a liquidity response in Europe with Credit Suisse. We've seen a liquidity response here in the United States and a rapid repricing of these rates. So I'm basically watching to see any more actions by the Federal Reserve, which is a sad state of affairs because when you look at the financial system, you shouldn't have to look at like what one guy is going to decide when he gets out of bed, or like one group of like people. But that's kind of the nature of the system. It's kind of designed almost like it just consolidates towards like the center over time. And because we're kind of in the later stage of that multi-decade cycle, it's now quite consolidated towards the center. And so watching what the center is going to do is essentially part of how you have to manage assets in this type of environment.
And did I see you say that the drop in the 2-year yield also may be the reason why Bitcoin is pumping right now?
I think it's certainly a factor. Basically, it's contributing both Bitcoin and gold, and some stocks that are doing pretty well. And it's things that were rate sensitive. So, for example, someone believed that Powell was going to keep hiking, that he was going to get the positive real rates and then hold them there for a long period of time. Then the dollar is super stable. And, it basically makes it attractive and it makes most other assets unattractive, right? If you can get a positive real yield on, your treasuries and your things like that, it makes other assets less urgent. On the other hand, if they rapidly cut interest rates, and they're not able to tighten even in the face of persistent inflation, then that makes those scarce assets more attractive. Things like Bitcoin, things like gold. And so if that breaks perceptions of overall Fed tightness, that is beneficial to those alternative scarce monies. Now, I'd be careful about chasing things in the near term. I mean, short-term moves can always reverse themselves over any multi-week or multi-month period. But I do think that Bitcoin is showing a lot of resilience in the recent months, and especially with this particular event, and that this is a good advertisement for Bitcoin. Um, and moreover, just that rates backdrop and the inability of Fed to tighten as much as they would have otherwise wanted to is beneficial to Bitcoin. And that's kind of always been part of the thesis. I mean, if someone believes that the dollar is going to get back on track and it's going to stop losing value, then, people can hold dollars. Whereas if, Bitcoin's kind of the thesis that that's not going to happen, the dollar is going to keep devaluing in purchasing power, even when taking into account interest rates. And therefore, that Bitcoin is a better long-term money to hold, in addition to being censorship resistant and global and all the other properties that it has.
Well, Lyn, your insights and forecasts have always been really spot on. You called the fact that this is a more structurally inflationary period that could have some, smaller cycles of disinflation where we could maybe see the interest rates go down. But overall, I mean, they can only do so much. And unfortunately, they haven't gotten inflation down low enough before they have to come in and assist the markets and intervene once again, because they're essentially on the brink of creating another crisis. But I think it's really helpful for people to know and see that you're saying we're not at that point yet of 2008 just yet.
Yeah, it's a very different type of crisis. I mean, these crises keep recurring. They're always a little bit different. They have different magnitudes. Bank failures are pretty actually common in American history, unfortunately. And so I would just make sure, people should make sure that their bank is safe, that they're, making use of FDIC insurance limits. Don't assume that all deposits are covered just yet. Take prudence. And going forward, there's even risks later this year because we still have the debt ceiling impasse. And, if the Treasury tries to after that's resolved, if they try to refill their cash account, that could be another source of liquidity coming out of the market. And so I think basically the Federal Reserve is going to have really big decisions later this year. And it's certainly not a position I'd ever want to be in.
Well, we can't be bailing out banks every 15 years. We can't be the world's bank if people don't trust that when they deposit their money, that it's safe. And it really does beg the question, how did Jay Powell, how did the Treasury Secretary, how did they not see this coming? Because if you can't expect that a depositor is going to be looking at all these financial statements, so you'd certainly hope that the CEO and the Fed chairman know this, but it looks like we might have more surprises ahead. Thank you so much for joining me, Lyn.
Happy to.
It's time to hear these messages from my partners. First up, Fold. Fold is the best Bitcoin rewards debit card and shopping app in the world. You can earn Bitcoin on everything you purchase, from Amazon to groceries to sprucing up your wardrobe with Fold's Bitcoin cashback debit card. And you can win free Satoshis every day, or even play for the chance to win a whole Bitcoin by spinning the daily wheel and the purchase rewards wheel. I have an alarm set every day so I don't miss out on spinning the wheel and earning free sats. And it's also a great app to get someone that is totally new to Bitcoin. So if you want to join the fun, head to foldapp.com/Natalie and get 10,000 in free sats when you sign up. CrowdHealth, a Bitcoin alternative to health insurance. Health insurance costs can be sky high today, and you essentially send money every month to a massive corporation the health insurance black hole, as I call it. And if you don't need any healthcare, you never see that money again, right? But if you do need to go to a doctor, you end up having to pay even more out of pocket, especially if you end up as one of the 20% of claims on average that aren't covered. With CrowdHealth, you pay a small monthly fee that goes into an account that you actually accrue over time and is yours to use or keep if you ever leave. You can even save that money in Bitcoin. CrowdHealth is all about community, and the community crowdfunds everyone's healthcare. So if something does happen or you have a doctor visit, CrowdHealth will negotiate down the medical bill much lower than what insurance would be, and then the community helps you cover it. And in return, you help others cover their needs. For more information, you can head to joincrowdhealth.com/Natalie. And if you use promo code Natalie, you get 6 months for $99. Thank you so much for checking out this episode of Coin Stories. Again, hit like on the video and make sure that you have those notifications on so you don't miss out on any new episodes. And I would love to hear from you. If you have suggestions, feedback, guest requests, please email me at natalie@talkingbitcoin.com. Thanks so much.